guest. It's a real treat. So I would like to welcome Sayeed Sanaullah, who serves as the first vice president of corporate strategy and strategic planning at Wells Fargo. Hello, Sayeed. Great to have you with us. Sayeed has over 17 years of leadership experience in financial services, banking, and the technology industries. He's a Wharton Fellow at the University of Pennsylvania Wharton School and a CFA charter holder. Sayeed, what a true honor to have you here and share your expertise with us.
Thank you, Jose. It's my pleasure to be here. Thank you for having me. And good morning or good afternoon to everyone, depending on your location. And thank you for joining me to learn more about digital growth strategies for financial services firms. So you might know that this COVID pandemic has moved more customers to digital channels than any single event in our lifetimes. Consumers who have never deposited a check by taking a photo, transfer funds between accounts using their mobile device, or communicated with friends and family using video channels were instantly made aware of the power of digital. So digital technologies and systems have reshaped the economic forces impacting the businesses, including banks. The need to move to a more digital banking model has been debated, planned, and played with for almost a decade. Digital technologies and systems have reshaped the economic forces impacting banks. So what are the factors or underlying trends behind these digital enhancements or digital strategies? Number one, it's the new pressure on prices and margins. So digital technologies create near perfect transparency, making it easy to compare prices, service levels, and product performance. Consumers can switch among digital retailers, brands, and services with a few clicks or finger swipes. The second factor is competitors emerge from unexpected places. So digital dynamics often undermines barriers to entry and long-standing sources of product differentiation. The third factor is the plug-and-play business model. As digital forces reduce transactions, cost, value chains disaggregate. Third-party products and services like a digital Lego blocks in effect can quickly be integrated into the missing pieces or be put into gaps. In US, the registered investment advisors have been fast-growing segment of the investment advisory business, for example. They're expanding so fast, largely because they insource turnkey systems, including record keeping and operating infrastructure, purchased from the likes of Charles Schwab, Fidelity, and others. So what's different now? We know all of these factors. This has existed for so many years, even a decade. So it's the COVID-19 that has made the need for digital growth strategies, improved digital experiences, and reduced operational cost more important than ever. So on the slide, you can see around these three key factors, there are elements around customer behavior. So the adoption of digital solutions leaped ahead by several years due to stay-at-home rules, and many new adopters may never go back. So with this health crisis, the customers are more willing, more accepting, and more welcoming than ever before to a digital channel, a digital platform, and digital service. So this presents the right opportunity for financial services firms to aggressively drive digital growth strategies. So there are 5 digital strategies for banks, which I will talk about during this session, that can fuel growth and profitability. And so if there were any lingering doubts about the necessity for digital transformation to business longevity, the coronavirus has silenced them. In a contactless world, the vast majority of interaction with customers and employees must take place virtually. With rare exceptions, operating digitally is the only way to stay in business through mandated shutdowns and restricted activity. It is go digital or go dark. So we will take a deeper dive into 5 digital growth strategies. Number 1, leveraging relevant ecosystems beyond the traditional core. So a banking ecosystem is an interconnected set of services where customers can fulfill a variety of needs in a single integrated experience. Number 2, developing a financial supermarket. So financial supermarkets can benefit customers by offering increasing convenience. Number 3, capitalize on growth opportunities shaped by customer journey. Banks can grow by engaging with customers at all stages of the decision journey. Number 4, monetizing customer interaction, engagement, and data responsibly. Companies can put their information to work by teasing out novel patterns, driving profitability, and creating new solutions. And the last and the 5th one is for the banks to evolve into a product, service, or infrastructure or platform manufacturing factory. That is, banks could provide platform, products, and services to newer developing companies. Those could be fintechs as well. And the banks need not compete with them. They could adopt a competition approach that is cooperate and compete. So diving into the first element of this 5 strategies, diving into the ecosystem. So extending beyond the core allow banks to create ecosystem, helping the customers simplify this daily life. So you can see on the screen, there are 3 layered circles. First one is the core. The second is a banking ecosystem. And the outermost, or the 3rd layer, is the non-banking ecosystem. And this screen are the circles, the concentric circles. They have been divided into 2 parts. The top half is business to consumers, and the bottom half is business to business. So in a digital banking environment, there is no reason why financial services organizations should be limited to offering only traditional core banking services. In fact, the future of banking will most definitely include the integration of products and services from a wide variety of providers, all focused on helping consumers simplify their daily life without leaving a primary financial institution's portal all on a mobile device. And an ecosystem provides 3 key value components. Number 1, reduction of friction between related services. Number 2, leverage of network effects. Number 3, integration of customer data across a series of services. So banking ecosystems often operate across traditional industry boundaries with different players working in the same space to deliver to banking customers services they need and value. Idea Bank and ING, for example, have extended into banking adjacencies by providing services like account receivable management, factoring, accounting, and cash flow analysis to small and medium enterprise customers. Some banks have even gone further and moved into non-banking adjacencies. Postbank, for example, have become the largest provider of mobile services in Italy. Other banks are partnering with care providers and health insurers to provide a consolidated billing platform that makes it easier for consumers to pay for medical expenses. And non-financial examples of consumer ecosystem already exist, which the financial industry could learn a lot from. And the examples of such non-financial consumer ecosystems are hospitality, healthcare, travel, and others. For instance, in the travel ecosystems, they help a traveler secure a flight, lodge accommodations, get a rental car, find a tour guide, and even restaurants and entertainment. So these financial services firms could act as a life moments orchestrator, that is, build their own ecosystem across specific life moments, offering partners access to their own digital customer base in exchange for fees. These ecosystems could also help with expanding primary relationships by offering hyper-relevant experiences. It could even help with reducing customer churn because the banks can deliver more meaningful customer experiences and can follow customers beyond boundaries of traditional relationships. Now, the banks should consider this option and should start thinking about ecosystems when they have a significant market share in one or more of core product areas. So they have already captured as much growth opportunity as possible. So putting in more effort in another core product or the same core product would be less beneficial than expanding into an ecosystem. And that is when the bank should consider this option. The next strategy is the financial supermarket. So banks can operate as a market orchestrators or a supermarket participant. So taking a page from large digital businesses, banks can offer a curated and vetted mix of internal and third-party offering. This aggregation model provides customers with easy one-stop access to financial products and the ability to address multiple financial needs through a single integrated channel. To build a privileged relationship with the customers, these supermarkets for product offerings could combine a wide range of services. Now, in the concept of marketplace, the banks could operate again as a marketplace orchestrator. That is, they could create a marketplace where they are putting their own products as well as the products of their competitors, smaller or bigger, and also non-financial products to their customers. They could also join a third-party ecosystem as a participant, offering their own banking products to third-party customers. In fact, this kind of marketplace could also be used as a referral platform. So both for incoming and outgoing. When I say incoming, so if there are things which a customer finds in the marketplace, and that could help attract new customers for the bank, or if there are services which the bank could not offer, they could direct such customers to other providers. So in this case, the bank should consider this option if they want to provide a breadth of choice or price comparisons to the customers. In fact, in terms of breadth of choice, it's already there in the wealth and investment management business. Most of the large wealth and investment management firms have an open architecture platform where they offer investment products from the competitors as well. However, if there's price comparisons important to the customer, we already see that in the property and casualty insurance business. But expanding it to other product areas can allow banks with a strong position in such areas to grow in these segments as a complement to their offerings. So the next or the third digital strategy is around customer journey. So enhanced digital customer journey to provide customers product and service information which can be delivered effectively and seamlessly. So for most consumers, working with a bank is just a means to an end, that is ensuring a secure retirement, growing a business, or buying a home, for example. Most banks, however, tend to focus only on discrete bank-centered moments in the customer overall journey, such as offering a mortgage when the customer's larger goal is buying the house. By attending only to bank-related part of the overall journey, banks could be leaving considerable value on the table. Banks can grow by engaging with the customers at other stages of the decision journey. For example, a bank might give advice to customers on how to save for retirement and borrow for a home, or help them to determine best rates and maturities for financial instruments. So on the left side of the slide, you can see discover, design, and deliver. That is the digital customer journey. So with all of those information available digitally, it could be tailored, it could be made more personalized, it could be made more just in time, it could be a cross-platform. To give you an example, Commonwealth Bank in Australia, for example, wanted to play a bigger role in home buyers' journey. So the bank created an augmented reality app that allows users to point their smartphone cameras at a property and instantly see its current prices and sales history. That's what you're seeing on the right side of the slide, that it is a depiction of an augmented reality app where a customer is using a phone to point out at 3 houses. It shows certain details like the sale price, the features in terms of number of rooms, number of bath it has, what's the address, and that is where the banks could come into play. That the app could also provide a mortgage calculator and other financial tools, plus the option to connect with local realtors. So such are the elements of the customer journey, particularly digital customer journey, which banks could tap into. A financial services company can also take action on location data and mobile activity data. For example, an avid cyclist who often takes a particular cycling route to work can have his or her data tracked in real time after analyzing the cycle activity, frequency, the location, or even if the customer or the cyclist is taking a picture of a great scenery he's passing by, the financial service provider can send targeted third-party offers, or even from sports shops, or even just show what other shopping avenues are available as the customer passes on this journey. So when should a bank consider these options? So banks should consider this option when they have significant market share in financial products that are integral to a large buying process. So for example, for a house, it's a large buying process. Does it have a significant market share in financial products? So it could leverage those. Or not just house. Say someone is shopping in a furniture store, and some of the furniture could cost a lot of money, and say someone is taking a picture or using an augmented reality app. That is also where the bank could share their interest rates as well as the multiple payment terms to help the customers make a purchase more financially meaningfully, as well as satisfy the immediate needs. So engaging across buying journeys can allow banks in such a position to gain access to a larger pool of potential revenue and enrich overall relationship with the customers. The fourth strategy, which we will be diving deeper, is around information monetization. So making better use of information or data responsibly can help banks drive customer centricity and business value. So more than half of financial services respondents in a recent McKinsey survey said that companies had begun monetizing data. What is more, data and information monetization seems to correlate with industry leading performances. There are multiple ways to monetize data. The first is for a bank to use its internal data more effectively for its own operations by adding new analytical capabilities. Another is to create new offerings such as reports or benchmark analytics based on bank data. There are several Canada's biggest banks who have partnered with a Toronto-based secure key in a system that allows individuals to use their bank credentials to access to online services from federal government. The system works in much the same way as websites that allow users to log in using their Facebook account, except in this case, the Canadian government agencies provide access to online services when visitors enter the bank credentials. So most of the banks have rich set of exclusive information on the customers, which would include key demographic details, where they live, their lifestyle preferences. When used responsibly, and that is extremely important, that is when used responsibly with respect to regulatory constraints and privacy concerns, this data can be analyzed for insights valuable to companies in financial services industries. And there are three key data monetization approaches, and that is what you see at the bottom half of the slide, depicted by three gears. So once the data comes into the funnel, the first stage is around data decisioning. That is leverage insights to enhance processes, utilize the insights from customer and execution data to enable demand-driven innovation, ensure the time to market, provide just-in-time insights to make customer interactions easy, quick, and transparent, which is positive and full-featured. The second gear, which you can see on the bottom half of the screen, is data products. So offer data as innovative products, bundle it to deepen relationship with the customers, offer personalized products in different channels. And the third gear on the bottom half of the slide is around data partnership. To share core analytical capabilities with partners for mutual benefit while enhancing customer experience. So savvy organizations will follow on leveraging advanced analytics to extract insights from the customer data and continue internal and external data integration efforts to develop a more holistic view so that they could detect early signals which will be crucial in optimizing the customer experiences and redefining customer value propositions in line with evolving preferences and customer needs. So how or what would be the benefit of all of these data-centric or information-centric efforts? There could be four benefits: new sources of revenue, better products and services, which ties very well to improving the customer experience. There could be operational efficiency. Again, if the bank is more operational efficient, providing customers services which is faster and better, that again adds value to the customer. And the third, or the fourth, and the final is profit optimization. So when should the bank again consider this information or monetization or information utilization? First, they need to look at, do they already process an information advantage over competitors? So that is the information part. Second, they should also look at whether they have the systems, whether they have a connected system to better leverage those information, or if they have the prospect of creating an information advantage or extending an existing one, while even looking outside of the firm through external investments or partnerships. So now we will move on to the final digital strategy that is around considering large banks as a factory. So banks and fintechs can adopt cooperation, that is cooperative competition, to increase strategic value. So within financial services, it often looks like there's a stark choice to be made between cooperation and competition. The reality is that both coexist and feed off each other. Much of today's innovation is taking place as a result of partnerships between banks and fintechs. Many banks and fintechs are locked in a battle over customer-facing front end, but large institutions can create significant value by leveraging back-end assets to create and provide products or services to smaller banks and even new businesses. And that is because many small and non-traditional institutions lack core banking products, infrastructure, capital assets, or even banking licenses, and don't have the reach or resources to acquire them. On the other hand, large financial institutions can address this need by developing a portfolio of white label products to sell, or through third parties providing infrastructure as a service, and even renting their balance sheet to small and non-financial players. The classic example of this kind of services, which bank is already doing, is providing credit card processing to retailers. In the evolving digital era, many new opportunities to offer services like this are emerging. So you can see on the left-hand screen is that there's a depiction of large banks as factories, and there's fintech, and they are both competing as well as cooperating. And as an output of such a cooperation could be a platform where new innovative products or services could be offered jointly by the banks and the fintechs, which could be beneficial for the customers. So there are multiple examples. I can share a couple of examples. There's an example of Payconic app, which enables users to make direct mobile payments in store and peer-to-peer in partnership with ING. In fact, ING started with just having initial discussion with Payconic and developing something, but later on realized that Payconic could be a feature or functionality or a value-added services to ING. So while Payconic partly disrupts ING's existing payment systems, it also shows that ING could proactively deal with changes affecting their markets. There are a number of fintechs even in US which have partnered with large firms. For example, Sigfig has partnered with a large bank to provide wealth and investment management product services to customers who would be more fee sensitive, or whose assets or their needs or the complexity of the needs or less complexity of the needs would be more suitable to a low service, high tech platform rather than a full service financial advisors. ING has also partnered with the US-based fintech startup Cabbage to serve small and medium enterprises customers in Europe. So it could be applied even to B2C and B2B. And with Cabbage's easy-to-use interface and novel risk management algorithms allow it to deliver decisions on loan application in a matter of minutes. as a startup, Cabbage had a distinctive new capability but lacked capital and customer relationships. And that is where ING comes into the picture. So ING brought to the partnership its deep reservoir of capital and its existing relationships with prospective small and medium enterprise customers. So again, when should a bank consider this option? So for the bank, they should consider this option when they possess a significant backend capabilities that others don't have and the ability to extend into other environments securely. So particularly the fintechs, they may not have such rich customer data, they may not have a large customer base, or they may not be having the right level of tools to service those customers. They might be attractive to customers who are very sensitive about fees, so they may be able to target a certain set of customers. They may be able to understand those customers' needs through advanced algorithm, but in terms of mapping those needs to the relevant products and services, that is where the large banks could come into play, and then ongoing service of those needs, where banks could help small, new, or even fintech companies. So those were the 5 strategies which I wanted to share. So bringing it back to where we started with, that is digital banking source in the COVID-19 pandemic. So the pandemic induced developments in digital banking services are not fleeting. While the impacts of the coronavirus will lessen over time, the lessons learned for consumer and institutions alike will only deepen the reliance on digital services across all industries. From first-time digital accounts and mobile deposits to requests for payment deferrals, millions of customers have flocked to digital banking at a near historic pace during the stay-at-home public health emergency of the COVID-19 crisis. Digital traffic in the financial sector has soared, even in recent months, as large and small banks ramped up to respond to customers going digital amid the pandemic. Banks have seen a double-digit rise in first-time online accounts, mobile deposits, and mobile payments, and overall usage of online and mobile banking, according to polling research by J.D. Power. The numbers are showing no signs of abating, even as the U.S. gradually eases emergency restrictions. The COVID-19 pandemic has accelerated consumers' adoption of digital banking and payment options at a staggering pace. By employing digital channels or novel business models, incumbent banks can also enter new geographies or market segments, or be even aggressively acquire new customers or deepen the relationship with existing customers. So the banks comes in different shapes and sizes and with different capabilities. There could be certain banks who may not have as strong digital capabilities, and that is where some of the customers may not be appropriately served. So banks who have strong digital capabilities can better serve such customers who are not getting the right level of service with the existing banks. In fact, in U.S., the PPP loan participants or the companies, many of them didn't get the right level of service they expected, and they have, in fact, more than 30% of such payroll protection plan companies are thinking of switching their existing banks or financial institutions. So this kind of opportunity presents a scenario for the big banks to aggressively acquire new customers as well. And more importantly, these digital ways or digital approaches could be used even when it is prohibitively expensive using traditional approaches. So the bank should focus on the 5 digital growth strategies. To summarize, number 1, leverage relevant ecosystems beyond the traditional core, develop a financial supermarket, capitalize on growth opportunities shaped by customer journey, monetize customer interaction, engagement, and data responsibility, and the 5th and the final, evolve into a product, service, or infrastructure platform manufacturing factory. So with that, I thank you all for your time and attention. Happy to address any questions.
Saeed, thank you very much. Very good coverage of the trends that the bank is experiencing and the opportunities there in the landscape. So I'm gonna ask you to stop sharing your presentation so that the audience can see our screen in a bigger format. And I'm gonna go right into the questions that we're getting here from the audience. And the first one comes from Madan Devella, and Madan is asking, while you define the digital growth strategies, how do you involve the business IT teams in the organization and really any other teams in the organization as you're formulating the strategies and then thinking about strategy execution?
Sure. Thank you. That's a great question. And so, first of all, even looking beyond the IT or the technology, the most important thing is to set the vision, drive the change from the top. So it should not be like something is being pushed to a particular part of the organization, maybe technology or IT. It is extremely important to get the buy-ins. The IT or the technology function should not be looked at someone who is just a service provider. In fact, in the digital world, technologists or the technology function plays a much bigger role. So they should be brought in very early. Their voices and opinions needs to be heard, and that is extremely crucial to get their buy-in. And that is a kind of mindset change. So this kind of digital growth strategy should be driven from the top. But however, in terms of setting the tone, but however, in terms of engagement, it should come from the grassroots. The change should come from the grassroots, and that is even from the technology function. So there are 3 specific things which I would highlight in terms of getting the technology or IT team involved or engaged in the right way. Number 1, make communication a priority. Make the case for change and describe what you want to achieve, so that they also feel energized and they also prioritize this. Second, encourage engagement. Allow the technology team to participate by discussing and questioning the digital endeavor. Give them an open place to innovate and experiment. And praise when they succeed, and praise even when they fail, because learning from failure is also very critical. And the third is to focus on feedback loops and metrics. Get inputs from the technology, understand what the challenges are, so that they continue to see the momentum for this digital strategy shift. And it's okay if they can't fail fast. Make them that they succeed slowly, because sometimes with the regulations, with the kind of existing business platforms, it may be difficult to just fail fast, but make them ensure that they succeed slowly. Because many a times, some of these digital platforms, the realization of the value may come slowly, but the pace of the realization of value would increase over time. So again, to summarize, I would say make communication a top priority, encourage engagement, and focus on feedback loops and metrics from the technology and the IT team.
Very good. And tell us a little bit more about the collaboration on formulating strategies, especially on the aspect of getting the other groups involved and agreeing on which strategies to focus on. How has that shifted with this with the pandemic, and now we're communicating through media like this one. And how has that impacted your strategy design at the bank?
Sure. So, with the kind of situation which we are uh, in terms of strategy design, particularly related to digital strategy, what it has done is something which was planned for, say, over a 3-year period. Now that has been shortened into, say, 6 month or 1 year period. So that's the change in terms of timeline. Second is analysis or for reprioritization of some of the digital strategies which were in the pipeline. And I say that reprioritization because now the customer need is imminent. So focus on what the customer needs right now. And there could be situations where we may have to just provide a minimum viable product. It may not be a full-fledged developed product, but still reprioritize and provide a minimum value product so that customer needs could be fulfilled immediately. The third is to focus also on how the customer's behavior, how the customer's attitudes, how the customer needs will evolve in the next 6 months or to a year. So those are the 3 key changes in terms of how the digital strategy thinking has changed or evolved. To summarize, again, the timing has been shortened. Second, reprioritization of some of the digital strategies and minimum valuable product. And the third is looking at just the next 6 months, 1 year, and understanding how this COVID-19 pandemic could change or shift the customer behavior and respond accordingly.
And from Wells Fargo's perspective, what have become the first, let's say, 2 or 3 strategies with the shift in the market?
Sure. And just to understand the question, so from Wells Fargo perspective, what are the 2 or 3 strategies, digital strategies that the question about?
Well, let me put it this way.
Sure.
There has been a reprioritization of the strategies, if you will.
Yeah.
Based on this customer needs that you just identified, especially the digital strategies. If you can talk a little bit more about what have been the top ones that have gone to maybe they were like somewhere in the back burner, but now they're like in the forefront. What has shifted the most, perhaps?
Sure. And I can talk a couple of them, and one of them, which is very much out there in the news, and that is a unique kind of challenge as Wells Fargo is working through, is around regulations around fulfilling the requirements from the regulators. So in terms of digital strategy, we are putting more efforts and focus on fulfilling those regulations as well. So when you say what has changed, is now we see a greater value in automating a lot of things, even from the digital products and services perspective, which could fulfill the mandate of the regulators. That is one. The second is from Wells Fargo perspective, which is more customer facing, is enhancement on the wealth and investment management business, enhancement on how our Fidelity or Schwab equivalent of Wealth Trade is, or our non-traditional discount brokerage platform is. And what has happened is that we have put in more resources to educate the customers as well, because at this time we would see that there would be customers who would be getting on to a digital platform for the first time. So we have the right level of support from the call centers as well to educate the customers. And the third is around engaging the customers on the social media platform as well. Something which I talked about is understanding the customer journey or decision points, so getting inputs from the customers on the social media platform based on the conversations they are having, and then mapping that to the relevant products and services. Again, all of these needs to be done responsibly and in a way which meets the regulatory standards and also ensuring that the customers' privacies are taken care of.
Very good. Saeed, we're just over time, but I gotta ask a quick question that Erwin, who is based in Belgium, asked. He was asking on the data that you share that there was that big increase in digital demands, you know, the percentages. He was curious if that was Wells Fargo data or if it's industry data.
Sure. There were three, I would say, the blurbs on that screen. The top one, 14%, that's an industry data from JD Power. The other two in the bottom or in the middle of the slides, those are Wells Fargo specific data. However, as I mentioned, the top one is from JD Power. The similar trend is observed across the industry as well.
Very good. Again, such practical insight, both covering strategy and the practical side of strategy execution. We really appreciate, Saeed, you taking the time to share this journey and experience with us at Wells Fargo. Thank you very much for that.
Thank you so much for having me, Jose. And it was a pleasure sharing these strategies. And I hope the audience could make good use of it. And I'm happy to engage further on LinkedIn platform as well to answer any further questions or even hear feedback or any other suggestions.
Thank you very much, Saeed. We appreciate that.
Thank
All
you
right,
all.
ladies and gentlemen, as you heard Saeed just say, you can join in on LinkedIn and you can continue the conversation, ask questions there. Saeed will come in and answer some of your questions. So again, thank you, Saeed, for being part of our journey here today. Our next speaker at the top of the hour is a leader from Voya Financial, and he's going to talk about the impact of COVID-19 specifically in transforming how we work, engage, and interact with each other within financial organizations, and certainly how we deliver value to our customers in the financial markets. So I look forward to seeing all of you back at the top of the hour. For now, we'll close the session, provide your feedback in the form that's available in the webinar interface, and we'll see you again soon. Bye-bye.